Hi friends, welcome to Adda 24/7. We are in the BFM most important questions and case studies. Here we are covering all the theory questions as well as the case studies for numericals as well as theory. So subscribe to the channel, click on the bell icon, share it with your friends. Don't miss any of these. Okay, let's move on. First we'll be doing some case studies related to Forex. Let's see, first one. Euro 1 equals to USD 1.31803190. This is a spot rate. See here, whenever it's given like this, it means it's a spot rate. Okay, so this is spot, right? Next is what? Forward differentials are 1 month is 1518, 2 month is 3037, 3 month is 4149. Now can you tell me from this currency is in premium or discount? Everyone, you tell me. This currency is in premium or discount? Yeah. Comment section. Everyone. The currency is in premium. Why? Because right side is bigger. Kindly note. Okay, right side means bid and offer. Offer side is bigger. Look at everyone. Whenever you see this in premium, you'll have premium will always be added. Right? There are three things in any forex. I always tell you. One is buy or sell. Second is what? Forward points. And third one is your TT margin. So in this problem, TT margin is not given. So forget this. This is nil. Cancel this. Buy or sell. Here it is mentioned as bid. What is bid? Buy means bid. Sell means offer. So this is bid. We want buy rate now. Buy. Bid rate. Okay. Forward points we have to find out. So spot is given. See this. What is the spot rate? 1. See this. Spot equals to 1.3180. 3180. This is my spot. Now I want 2 month bid rate. 2 month. So what is the 2 month rate given over here? 3037. So it is 30. I'll be taking 30 over here. So 0. Look at this, very important. 30 is over here. 0.3000. Start from this point. So your answer will be what? 1.3 plus 3 is 6. 180. This is your answer. No TT rate is asked. If this TT margin would have been given, then you would have added this TT margin afterwards. If asked. Okay. If it is not asked, then you don't do it anything. So this is your answer. Second one. Look at this. Now what we'll do, we'll add over here TT margin also. TT is given as, let's say, 0.15%. Okay, this is your TT margin. Now let's solve this. Euro equals to 2.31803190. So euro is 2.31. So this is spot. You want what? Forward differentials. 1 month is given, 2 month is given, 3 month offer rate is required. 3 month offer. Offer means sale. Now similar problem as the earlier one only. So first is decide buy or sell. Buy or sell. Now you tell me. Offer is asked. Offer means what? Is it buy or sell? You tell me. Comment section. It is sell, right? Offer is sell, sale. Then forward margin. We can take it. What is the month given? Third month. So I have to take it for third month. So what is the rate for third month? 49, 41 and 49. You tell me now. 41 or 49? I want offer means right side. So 49. Okay, TT margin. It's given over here. TT is given as 0.15%. Right? So all the three I can take it now. So what is the spot? 2.3190. Take 9 because offer. Right side. Okay. 3 months plus 0.4. It will be 8, right? 8 and 9 plus 1, 10. 80. 90, right? Is it correct? 90 and 80, correct. 2.8090. So you have got a forward point up to this step number 2 now, but step number 3 is remaining. So multiply this into 0.15 upon 100. Percent it is, right? 15 upon 100. So what is the answer? Check it, everyone. Give me in the comment section. Everyone, give me in the comment section. What is the answer for this? Let me see. Give it fast. So it is. Let me see in the comment section. 2.80. Let me also try. 2.8090 into 0.0015, right? So it is 0.0042. So it is 0.004 and 2, correct? 2. So what will I do with this TT margin now? Whenever we are selling it, sale. So sale is add. Always remember sale. So sale is add. I am selling it offer, right? Offer means sale. So I'll add it. So I'll add this to this point. So what will be my answer then next? So that is equal to, that is equal to 2.2 over here, 9 plus 4, 13, then 1 over here, 1 and 8. So 2.8132. This is your final offer rate, right? 2.8132. Got it? This is your offer rate. And this is the final answer. Got it, everyone? This is the way we solve this numerical. Got it? I've solved this many times earlier, some other numericals. But don't forget it. Now let's move on to the theory questions. But before that, everyone subscribe to Officers Adda 24/7 English channel. Click on the bell icon. Share it with your friends. Like the channel. Join the crash course. Very important one. Here, apt, to the point, fast batch, at the time of exam. What else do you want? And at lowest cost. I'll show you how to join it. Lowest cost. I'll give you the trick also. How to get the lowest cost. You can join the Mahapacks also. In the end, I'll show you. Okay. But let's continue with some theory questions. Which of the following are the objectives of using derivative products by the Treasury? Objectives of using derivatives products by the Treasury: to manage the liquidity ALM risk, to meet the requirements of the corporate customers, to trade in the currency and rupee derivatives, and all of the above. So which of them can be the objectives of trading in derivatives? And why do we use derivatives? Here, what are derivatives basically? What are derivatives? Derivatives means, look at this word, it is derived. Derived means it is derived from a underlying, that's called as commodity. Underlying, we call it underlying. Okay, means basically commodity. It is derived from some commodity. Okay, and then it is derived over here. Derived, it doesn't have its own existence. Okay, so suppose, for example, suppose if I am having this gold, so I can have the gold derivatives. I can have the gold derivatives. If I am having dollar, then I can have dollar derivatives. Means generally derivatives are used in the treasury to prevent the downside risk. Always remember. Means if you buy gold, this is called as long position. If you buy gold, buy. Okay. Buy gold, this is known as long position, long. So once you buy gold, you take a long position. You have to take the reverse position in the derivatives. You will buy put over here. Put means what? Put is always related to selling. Okay, so you'll have to buy put. So this is basically, derivatives are used just to, importantly, at least in your CAIIB, they are used to cover your risk. That is the first part. So to manage the liquidity ALM risk, to meet the requirements of the corporate customers, correct, that is also true. Because many of the customers come to you nowadays for having this derivatives needs, because everyone knows now there's a huge money in derivatives. Many of you also might be trading in this options market, right? Call and put. Of course, many of you might have lost the money. That's a separate part. But we trade, right? So it is basically used for the corporate customers also, because everyone understands today. And third one is to trade in currency and rupee derivatives. Why do we want to trade in currency and rupee derivatives? To earn profit. This is to earn profit. Okay. So always remember, earn profit. What are the three M's then here? Earn profit. So answer is all of the above. Okay. It prevents the risk also. It earns profit also. Okay. Next one. The treasury is planning to invest in a scheme in which it has to deposit 18,250 now, for which in return the treasury would get rupees 5,000 year end for each year of the next 5 years. Now advise the chief treasury officer concerning the investing in the scheme on the basis of required rate of return. Means basically you have to advise this treasury guy that whether you should accept this or not, and at what rate of interest do you accept it. So accept only at 10%, only at 12, accept at both 10 and 12, reject at both 10 and 12%. Now what is all this? Firstly, understand this question is similar to that of your present value problem. Okay, present value. Now what is the present value problem? Now look at this. Present value problem means you had this in your JAIIB also. What is the formula for present value? See here, you are getting it at a year end. So what you have to do is, it's a annuity, okay, and this annuity is what? This annuity due or ordinary. So it is ordinary because you are getting it at the end of the year. Okay. So in this case, what you'll have to accept is, you'll have to accept any project which will give you the present value. Look at this here. Right now, how much money is going out? 18,250 is going out now. So in future, what is the money coming in? 5,000 every year. 5,000 every year. Into means I'll just write it into 5. Okay. So I'm getting net 25,000. But this 25,000 is of no use. I want the present value of this 25,000. Present value of each 5,000. So how will I get this present value? The present value formula is, you had this, that's what I said. In your JAIIB you had it. PV equals to C into, remember this anyone? 1 plus R raised to N minus 1 the whole upon R into 1 plus R raised to N. Right? This is the formula for ordinary annuity. Same formula you'll have to use it. Now what are the options given? Look at the options and choose those options. Both of them you'll have to solve it. C is what? Your 5,000, what you get every year. 5,000 you are getting it. R is what? Now there are two R's. One R is, everyone pay attention now. One R is, I'll write it over here. R equals to 10%. Look at the options given. And second R is R equals to 12%. Okay. So you'll have to use the calculations 2 times. Okay. And what is the N? N is common. N is 5 years. N equals to 5 years. So you'll have to use this formula 2 times. So let's write this present value equals to 5,000 into, I'll do it for 1. Okay. 1 plus R. 1, what is R? Let's take it 10. So 0.1. 10 means 10 upon 100. So 0.1 raised to 5 minus 1 the whole upon R means 0.1 into, again the same over here, 1 plus 0.1 raised to 5. Okay. So what is the answer now? Find out the answer for this. Use the calci. Everyone try with the calci. Let me see who gets the answer first. (1.1 raised to 5). Keep it simple. 1.1 raised to 5. raised to 5. Use it into equal to 5 times. You'll get this as 1.61. So suppose if I take this, I'll write this separately. Look at this. I'll write it 1.1 raised to 5, right? This one equals to 1.61 something, isn't it? 1.61. Let's take it only 1.61. Okay. Now this 1.61 will be used all the time, means in the numerator also, in the denominator also. So it is what, 5000 into 1.61 minus 1. 1.61 minus 1. So it is 0.61. So 0.61, right? Do it everyone. Everyone. This is your JAIIB. In JAIIB also you had the same problem, right? Upon R. This is 0.1. Upon again 1.61. So it is 3.79 into 5000 into 5. So it is this part is coming out to be 3.79, this part. Okay, this part. So that into 5000 now. If you multiply this, you'll get it what? What is the answer you guys are getting? Let me see. See here, you have to try this because these questions come to you in exam. 18959. So this is 18959. Is it greater than whatever I have invested? It is greater than 18250, right? So this I can accept it. Now let's look at 12% also. If I take this 12%, what am I getting? Look at this. P equals to 5000 into what? 1 point, directly I'll write it now, 1.12, because 12% raised to 5 minus 1, the whole upon 0.12 now, right, into 1.12 raised to 5, right? Solve this everyone. Now give me the answer directly. Everyone be fast. Okay. So 1.12 raised to 5, how much are you getting? 1.76, right? What is the answer? Are you getting the answer as, let me see first in the comment section. If I give you the answer, everyone will get the same. Let me see how many of you are getting this. Everyone, please, yes. This is sort of case study, okay? So this answer which you are getting is 3.61. This is what answer I am getting, 3.61. So 3.61 into 5000. So 3.61 into 5000. Multiply this now. So 18047. Are you getting this? 18047. So is this greater than my investment? It is less than 18250, right? So I will not accept this. This will be rejected. I will accept this 10%. So accept only at 10%. This is your answer. You cannot accept it at 12%. Everyone got this? How did we get it? Did you get the problem? Because here, this problem is a bit tricky one. Tricky in the sense you have to, this considers the present value of money. The logic behind present value of money is whatever investment I make, it should always give me my present value of the future cash flows should always be greater than whatever I have invested. That's the basic logic. Okay. So are you getting this everyone? Okay. Move on. Clear this concept? Because if this question comes to you in exam, this present value question will be there in your CAIIB. Which of the following is correct regarding the buyback of certificate of deposits? Buyback. You want buyback now. Buyback means I've issued the CD. Means I'm the company. I've issued the CD. Certificate of deposit is what? It is basically the investment tool. Okay. Means I'll give you the CD. You will give me the money. Okay. So which one is correct regarding the buyback? Buyback can be done only after 30 days of the issuance of CD. Means today I issue the CD, I can buy it back tomorrow itself. Minimum 30 days. Let's see. But we want the correct one. I don't know whether which is correct. We want a true one. It is done at a prevailing market price. Means suppose if I have issued the CD at, let's say 10%, and after 1 month, let's say 1 month, I am buying it back. If the rate going on is 12%, then I'll have to buy it back at 12%, not 10%. The bought back CDs can be reissued. Means I can reissue those CDs again to someone. So which one is correct? Think about it. 16th one, yes. The answer is only A and B. A is the answer. See here, buyback can be done only after 30 days of issue of CD. It can't be done before that. Okay. What is the minimum investment in CDs here? Minimum investment in CD is 5 lakhs. Always remember, minimum investment is 5 lakhs. Okay. CD and CP both have been made 5 lakhs now. So 30 days of the issuance of CDs first. Second one is what? It can be done at the prevailing market rate. Correct. Means even if I have issued, it's like issuing the share. Suppose if I give you the share at rupees 1000, and after 1 year if I am planning to buy it back from you, so I'll have to buy it back at that rate, whatever is going on at that rate, right? I can't buy it at today's rate, isn't it? It may be profitable for me, it may be unprofitable for me. Anything is possible, isn't it? Okay, so A and B is the answer. Which among the following is not an element of tier 1 capital? Not, remember, not an element. Revaluation reserve, paid up capital, statutory reserves, other disclosed reserves, perpetual non-cumulative preference shares, innovative perpetual debt instruments. Which of them is not? And E, I think so, it should be none of the, all of the above are the elements. Let me write it. Okay. Yeah. By the time you think which of them is not an option, not the this part of tier 1. So which of them is correct? Revaluation reserves. Always remember, revaluation reserves are taken at 55% discount. Okay, so they are taken at 45%. Okay, so these are the part of tier 1. So this is true. Paid up capital, ordinary shares, statutory reserves, and other disclosed free reserves. True. These are also the part of your tier 1 only. PNCP, these are also the part of your tier 1. IPDI, these are also the part of your tier 1. Remember, tier 1 is made like this. T1 capital has two parts. One is CET1, and second is this AT1, additional tier 1. Okay, CET1 has normally share capital, shares means paid up capital, shares, then net profit, then reserves and surplus, R&S, and revaluation reserves, reserves. Okay, these are the part of your CET1. AT1, there are two parts which are there in your CAIIB. There are many parts, but mainly in two parts. One is PNCP and second is IPDI. Okay, so these are the parts of tier 1. Why? See here, these are also bonds only, but these are long-term bonds. PNCPs are generally issued. What is PNCP? Perpetual non-cumulative preference share. Means what? What is non-cumulative? Non-cumulative means if I issue the share today and if I don't give you the dividend in 1 year, so it's not compulsory for me to give you the dividend in the next year along with arrears. No compulsory dividend. Simple meaning is this. That is non-cumulative. Preference means what? Preference shares are always issued to those while starting the company. Okay. So perpetual, what do you mean by perpetual? Long term, very long term. Perpetual, anything perpetual means very long term. IPDI means what? IPDI is similar. Innovative perpetual debt instrument. This and PNCP are roughly similar. PNCP is also a part of IPDI only. Innovative Perpetual Debt Instrument. This is a debt instrument. So PNCP is a part of IPDI. Okay. So all of them are the part of tier 1. All of them. Got it? So got it? The answer is all are the part of tier 1. All of them are. So as I told you, in the end I'll be showing you how to join the Adda 24/7 classes. So go to Adda 24/7. I'll always suggest you to go through the app. In the app you get 1% extra using the coin systems. So go to Adda 24/7. Click on JAIIB and CAIIB. Click on JAIIB and CAIIB over here. Look at this. JAIIB and CAIIB. Click on CAIIB November. Join this crash course ASAP. As I told you, apt, to the point, right at the time of your exam. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, everything is available. At what cost? Click on buy now. Put the code Y432, Y432. Click on apply. 77% discount plus 1% extra using the app. So use this offer immediately, 78% discount. You can join the Mahapack also. In Mahapack you are getting 15 plus batches per subject, plus you are getting electives, plus marathons, everything. Join it ASAP. There also you get